The US dollar is more than just the currency you use to pay for goods in the United States. It's the anchor of the global financial system. Its strength or weakness has a ripple effect across markets worldwide. Recently, the USD has been gaining momentum, and traders around the globe are paying close attention. But why is this happening, and what does it mean for investors, traders, and everyday people holding money in other currencies? In this video, we'll break down the drivers behind the dollar's strength, explore its impact on global currencies, and highlight the critical signals that traders should monitor before making any moves. One of the most important factors influencing the USD is the Federal Reserve's monetary policy. When the Fed signals higher interest rates or tighter economic policies, the dollar often rises. This happens because higher interest rates make USD-denominated assets more attractive to foreign investors, drawing capital into the United States. Even subtle hints from the Fed can spark significant movements in currency markets. Traders carefully analyze statements, minutes, and speeches from Fed officials to anticipate rate hikes or policy shifts. For example, if inflation is higher than expected, the Fed may act more aggressively to keep prices in check, which usually strengthens the dollar further. Economic data also plays a major role. Key reports like GDP growth, unemployment figures, and inflation metrics provide insight into the health of the U.S. economy. Strong data can fuel optimism that the dollar will continue its rally, while weaker than expected numbers may cause traders to question the sustainability of its strength. These reports are often timed events on the economic calendar, and experienced traders mark them in advance to position themselves before volatility hits. Global factors add another layer of complexity. Political instability in Europe, slowing growth in China, and geopolitical tensions in regions like the Middle East often push investors toward the USD as a safe haven. For instance, when uncertainty rises in the Eurozone, capital tends to flow from the euro to the dollar, strengthening the greenback against the euro. Similarly, global crises can create sudden surges in USD demand, making it crucial for traders to monitor international news and macroeconomic developments. The USD's strength also impacts commodities and trade. Since many commodities like oil and gold are priced in US dollars, a stronger dollar makes them more expensive for foreign buyers, often reducing demand and affecting global prices. At the same time, exporters in other countries may see their goods become costlier for US buyers, which can slow trade and impact foreign economies. Traders need to watch commodity markets closely, as changes in prices often signal broader movements in currency pairs. For those who rely on technical analysis, chart patterns and key levels of support and resistance are invaluable tools. Major currency pairs such as EUR/USD, USD/JPY, and GBP/USD show distinct trends, and understanding these trends helps traders anticipate potential breakouts or reversals. Indicators like moving averages, relative strength index, RSI, and MACD can provide clues about market momentum. Combining these technical tools with fundamental analysis, such as Fed announcements or economic data, gives traders a more complete picture of potential opportunities. Market sentiment and positioning are also essential. Traders and institutions often reveal their positions through reports like the Commitment of Traders (COT) report. Large shifts in speculative positions or hedging activity can foreshadow significant moves in the dollar. For example, if hedge funds start heavily shorting the euro against the dollar, it may indicate confidence in USD strength, which can trigger further buying pressure. Understanding how different players are positioned can help traders anticipate volatility before it happens. Another layer to consider is the correlation between the USD and other asset classes. Strong dollar periods often coincide with weaker gold and commodity prices, while equities in emerging markets may underperform due to higher borrowing costs and reduced competitiveness in global trade. Traders who watch these correlations can gain insights into broader market trends and potential risks. For instance, if the USD rises sharply, commodities might fall, and traders in commodity-linked currencies may need to adjust their strategies quickly. It's also important to remember that currency markets are influenced by expectations, not just current events. Traders constantly price in forecasts about interest rates, economic growth, and geopolitical developments. This means that even before a Fed announcement, if markets expect a rate hike, the USD may start strengthening in anticipation. Monitoring sentiment through tools like options pricing, futures contracts, and investor surveys can provide early warnings of potential moves. For active traders, timing is everything. Understanding when major economic reports are released, when central banks speak, or when political events occur, can provide an edge. While the USD can trend steadily over months, short-term spikes often happen around news events. By combining careful analysis of fundamentals, technical levels, and market positioning, traders can manage risk and seize opportunities in a rapidly changing environment. In conclusion, the strength of the US dollar is not an isolated phenomenon. It's the result of a complex interplay between Federal Reserve policy, global economic conditions, commodity prices, technical levels, and market sentiment. Traders who pay attention to these factors are better prepared to anticipate moves, manage risk, and capture opportunities. By staying informed and disciplined, you can navigate the global currency markets with confidence, whether you're trading for the short term or managing long-term positions. The USD will continue to influence markets worldwide, and understanding its movements is essential for anyone serious about trading or investing.